Well, hello again, everybody. This is John Norris at Trading Perspectives. As always, we have our good friend Sam Clement. Sam, how are you doing?
I'm doing great, John. How are you doing?
I'm doing fantastically. Right now, as we record this on the 16th, it is beautiful outside, and I'm looking at more green ink in the market.
Kind of hard to be upset right now.
Listen, green leaves on the trees, green leaves in people's wallets. The market goes up and up and up just because. What do you think about that, Sam?
Just because. There's always a reason.
Well, last year, we started off the year kind of hot, and then we got kind of cold, and then we didn't really know how the market was going to end. We were waiting for Fed rate cuts all throughout 2023, a good chunk of the year at least. We never really got them, as we all well know, but in November and December, people just started feeling really good about the potential for the Fed being very aggressive in 2024 and cutting rates. And then in December, after the FOMC meeting there, Jay Powell said pretty much 3 rate cuts, and people took that to mean 6 or 7, and market just rallied like crazy to end the year. And thus far in 2024, the hopes of rate cuts have come, they've gone. Now all of a sudden people are thinking, okay, maybe 2, we've been thinking 7. Regardless, the hope of new money is out there, but at some point, is that alone enough to keep fueling the markets? Because when I'm taking a look at stuff for the S&P 500, again, as we talk here on the 16th of May, like what, 12% for the year?
12%, yeah.
And I'm kind of looking at it going, how much wind is left in these sails?
It's a great question, and there's obviously no way we can fully confidently answer that. But you
can look into the crystal ball that's right in front of you.
I don't see that answer in it right now. But you mentioned how much more can this have, and the shift from 7 cuts to 0 to 2 to 3 ish, and again changing on the day and really changing on the Fed speaker of the hour. It seems to be shifting it so much, and I don't know. My biggest hope, if the market is going to continue, which I think the story gets a lot harder, is do you really need rate cuts for stocks to go up? And I don't think that answer should always be yes. And I think historically that's not the case. The market and young investors, which I would probably put myself into that boat.
You would have to compared to me.
Tend to think we have been, for the last 15 years, really, in this market of lower rates means stocks go up.
Yeah.
But that's not always the case, and historically has not been the case.
Well, a few years ago, I could have made the argument that lower interest rates actually short-term can goose an economy, but a steady diet of longer-term rates thereby depresses risk-taking because you just can't make as much money and will ultimately retard returns over the long haul, as we saw in Japan. And as we've seen in much of Europe, didn't really catch fire here in the United States, what I just said. But even so, I do believe that lower structural rates for a long period of time is anathema to long-term strong economic growth. Now, with that being said, sitting around waiting for the Fed to cut rates in the hope of a B12 shot in the economic arm is kind of crazy. And sitting around thinking about it, hoping for it, people are wanting the cheaper money, get more deals done. And in the meantime, the S&P 500 has gotten to some valuations which historically would be kind of difficult to justify, particularly with interest rates where they currently are.
I want to expand on one of the words you just said, and I think
what word is that?
Historically. I tend to think, and I don't have the answer to the question I'm about to ask. I tend to think valuations justifiably should be different than they have been historically.
Kids these days.
If a company averages 10% margins and a company averages 20% margins, historically that company that averages higher margins is probably going to trade for a premium, right?
Should. And
that's where the market as a whole has gone. And the comparison I've always heard and I like to compare it to is just talking about movies. Movies 10, 20 years ago, you can tell when a movie was made 10, 20 years ago versus now. The quality is that much better. And I think the quality...
You think so?
In film itself.
Okay, fair enough.
The film itself.
The quality of the production.
The production, sure, yeah. That's a good word. But I think that has also happened with companies, too. So what kind of premium on companies now with higher margins is justified versus companies with margins from 20, 30 years ago?
Well, there are some old folks like myself that would sit there and say, I hear you, but maybe are you outthinking yourself just a little bit? basically saying that the quality of earnings might be a little bit higher now than they were. And ultimately, I would tell you it doesn't matter. It's because earnings per share is earnings per share. It's how much do investors want to pay for each unit of profit that a company generates per common share. And when I take a look at things, it's like, doesn't matter if it's 1970 or 2070, it does come down to how much money am I getting back for my investment.
Yeah.
And I would sit there and tell you that historically, for long years, the first part of my career, people would have said 15. That's what the PE multiple should be. I'm going to be willing to pay $15 for every unit of EPS. I'd say that number is probably, because of some of the things that you're talking about, comfortably 17, 18. Yeah, I would just say 17, 18. I would say that. I think we're more productive now, can use technology more effectively, maybe not as capital intensive with a lot of our industries, which enables us to be more nimble. Okay, I'll grant you that, and I will say I will spot you 2 to 3 percentage points on the PE multiple. However, when I sit there and take a look at a trailing PE, like what we have right now in the S&P 500, again here on the 16th, it's close to 24. And when I take a look at the forward PE multiple, it's close to 25, 26. And so when I'm taking a look at it, and that's according to the Bloomberg, when I take a look at things, I'm going, okay, that's pretty rich. I'll buy it. However, something's going to happen. Either economic growth is going to have to accelerate, or interest rates are going to have to come down. And so that should, in order for me to justify paying that amount of money.
Yeah, and you kind of hit on something. Stocks can mathematically only go up for 2 reasons.
Yes.
It's either earnings or the expectations of earnings.
That's fair. That's better put.
Are going to be growing, or you're just willing to pay more for that same amount of earnings. There's no mathematical way outside of those two that stock prices go up. And historically, it's earnings with fluctuations in the multiples that people are willing to pay given the time period. And so that's really, I think, what you're hitting at. The main question is, where is this going to come from for the rest of the year, 12 months from now, 2 years from now? That high multiple that people are seemingly willing to pay right now tends to sound like it has to come more from earnings, upside earnings.
Well, I would agree with you 100%. Absolutely not trading perspectives on that at all. However, while you were talking, a question popped into my mind. Recently we've talked about the disconnect between people's perceptions of the economy and what the official data and what the administration would like for them. I mean, if I'm Joe Biden, I'm like beside myself. Why can't people get it? However, the complete opposite is true, it seems like, with stock investors. So why is it the American consumer or the general population feeling so negative about things, but investors, conversely, are feeling so positive about it? Simply, you would think that there would be a pretty strong positive correlation, but there seems to be almost a negative correlation.
And that's interesting, because you tend to get consumer sentiment largely off 2 things, and one we highlighted last week. I think gas prices in the stock market tend to give you a good idea of typically how the consumer's sentiment is directionally headed. Gas prices aren't going much higher and the stock market's going higher. Consumers tend to, at least how it's measured, feel better, vice versa. That's kind of been broken. I mean, the Dow crossed 40,000 today. It's phenomenal. And consumers still don't seem to be all that happy. So,
but why?
That's
a real good question. It's like, I wish I had the answer for that. I wish my crystal ball would tell me that. And I keep on coming back to, well, what else am I supposed to do with my money? Everyone would tell you that ownership, equity, is the best way of generating wealth. It's not putting your money in a mattress or underneath a mattress or in a coffee can or what have you. It's ownership. You're taking that risk. You get the upside. You also get the downside too if it doesn't work out. But everyone's heard that. You have more people than ever participating in 401k plans, passive products, all that stuff. Do you think, arguably, maybe or inarguably, as the case may be, that the prevalence of passive products and the sheer numbers, millions of people participating in 401k plans and the like with passive products, is driving the market higher and could potentially justify slightly higher multiples because moving forward, because people are setting things and forgetting them.
We may be trading perspectives here. I don't think passive has as big of an impact because I think prices are set on the margins largely. I think the active community and the active traders and investors on the margins are who are setting prices. I think the 401k community, and I do think multiples, you're always going to have this probably a little extra demand, but I think at the end of the day, prices are set on the margins. And I think we'll continue to see that. And I could almost argue that the more people getting out of the active space could start to better regulate prices and better regulate where stocks should be.
Believe it or not, I don't disagree with you on that. I just throwing that out there, trying to play a little bit of devil's advocate because I believe people in their 401k plans are more reactive than proactive. Mm-hmm. And it is the hot money and the active guys that when they rebalance back and what have you, that's what sets prices in motion. And then typically the weekend investor or the Monday morning quarterback or what have you, they follow suit, and the trend, and that's just the way it happens.
Yeah.
So, but when I'm taking a look at things, taking a look at how pretty it is outside, taking a look at the stock market, frankly, Sam, we can talk about it until we're blue in the face. I just don't know what the markets can continue to do for an encore. I've been pretty forthright with it. I think the summer could be pretty volatile. May has been confoundingly, although in a good way, confoundingly strong. Mm-hmm. I don't see how we keep on having these 4% type months without the ultimate and inevitable correction being greater than what I thought it was going to be at the beginning of the year.
It's like you've said and like I said earlier, the story going forward gets harder when you just look at the pure math of the two reasons that stocks can go up. That by no means they won't continue to go up though. So it's that balancing act of where is this going to come from, not having an answer, but also pointing to some historical trends that, on average stocks are up 20% or more in a year more often than they're down in a year. And that average 8 to 10% return that we've gotten over time, or 8 to 12%, almost rarely actually happens in a calendar year. So we tend to get those big, wild swings in the market. And that's what you mentioned. You're owning companies, you're owning equity, you're owning the risk in it. And that risk kind of wildly fluctuates between years, in years, over any sort of time horizon.
So what do you think, and this is shifting to the side just a little bit, what do you think could alter this era of good feelings, good tidings, to change the investor psyche from, I would say, pretty doggone positive? What could change it to being negative? Because when I take a look at the news out there, read the headlines, see what's going on, see the trends in society, it all seems pretty negative, and yet we seem to be pretty positive about things. What could, or should happen this summer to get people to quit feeling so positive about their stock portfolios?
I think if we saw, the easy answer would be if earnings collapsed, which I just don't see.
I don't see them collapsing.
That's always a reason why people would. Yeah. If you start seeing big misses from big companies and not just a handful of them with some
so much of that stuff is now on autopilot.
Right.
Truthfully.
I think the biggest risk to the market personally is if term premiums start rising, and that could get real into the weeds. But if the money required to invest longer term in bonds starts going up more than it has, I think that's where the market starts to have some risk. Well,
given the fact that the Fed has now pretty much said that they're going to unwind their quantitative tightening or shrinking of their balance sheet, would you argue that could potentially put a de facto put on the bond market? And if that's the case, if interest rates aren't going as high as they would have, could, or should have, do you think that enables stock investors to remain more positive for longer?
I think that's a big part of it, and I think that is the optimist story. There's several outcomes we can have for this market cycle. We can have this hard landing that some people are talking about where, it's an earnings collapse, it's what have you, a significant drawdown.
But do earnings really collapse when inflation's percolating?
No. We could have this soft landing where inflation continues to come down a little, maybe not the best economic growth, but right now we're still having pretty strong economic growth. Or maybe we get this economic nirvana where it's, earnings remain strong. We get 10 to 12+% earnings these next 2 years. We get term premiums that don't really rise. If 30-year goes to 4% or what have you, and that's kind of that sweet spot, and it's a tight window where it becomes nirvana for stock markets.
I mean, what you just described certainly would be nirvana. I mean, just would be sort of like, let's throw out everything we learned in school. Let's throw out everything that we learned in, or at least I learned in graduate school 30 years ago. Let's throw all that out because it just doesn't apply any longer. Do you think that the rules have changed? Do you think moving forward, people of a younger generation are going to view the markets differently, view things like PE multiples, PEG ratios, term premiums, they're going to view them differently than people of my generation?
I think so, a little bit. I think, the PE is the most commonly talked about ratio for how expensive or cheap the market is. And I think that's one that is already relatively antiquated, just talking about price to earnings multiples, because some of these companies are consistently growing at higher rates than we thought were possible previously. They're growing 30, 40 plus % with 50, 60, 80% margins on their products, and continuing to do it at scale that previously seemed impossible for a company that was $1, $2, $3 trillion. So I think some of these metrics that we're looking at, I think you're already seeing younger consumers invest in companies that they just believe in the products and dismissing multiples. I've seen it with restaurant companies. People just love the food at a restaurant, and this stock may be trading at 50, 100 times forward earnings, but they believe in it, and they believe the company is going to grow its way out of that extreme multiple.
So do you think it's virtue investing? I mean, is that what you're saying from virtue investing from your generation?
A little bit. And anecdotally, I feel like I've seen more advertisements for that in the brokerage industry, how you can customize these kind of trends you want to do. I think it was Schwab that talked about, these themes that you can invest in, and you can tweak the percentages and take out companies that you don't believe in. And so you are getting more slightly away from this invest broadly in the market, and then shifting it towards invest in this theme or this company that you believe in the company, independent of the multiple. You believe in the company. It is almost a ballot box for people.
Well, that's going to take a little while your generation accumulates its wealth, right? Mm-hmm. I mean, it's not going to have quite the same amount that the baby boomers have and the Gen Xers have. People that are largely kind of fueling the markets with excess. Well, not excess, but savings and balances and 401ks and what have you. What's it going to take for your generation to convince my generation that you're right?
I don't know if we. I don't know if we have to.
Actually, that's
just wait it out. That's my dark answer on that.
Well, there I am. I'm dead man walking, I think.
You see trends in markets, and there's I think long-term cyclical trends that you see, and the democratization of the markets, I think, is one that we're still early in the process of.
Right,
I think the markets as a whole have gone from stock brokers in the past, what you were buying or what you were paying them for was this knowledge and information gap that they could provide you tips and stock tips that you couldn't get otherwise.
Well, also then just sheer access to individual shares.
Right. It was this access to knowledge and actual securities.
Now you can get that access anywhere.
The whole environment and the value add and the value proposition has changed entirely. And I think we're still in the early innings of that.
So does that cause some of the premium that we're talking about? The democratization of the investment markets as more people have access to it and knowledge is more perfect?
I don't know. Again, I go back to, I think an individual company's circumstances in the short term, it 100% can impact it. I mean, we've seen it these past couple of weeks with the GameStop and AMC reviving themselves with the meme stocks. But I think, again...
I find some of that frustrating, by the way.
Yeah, to me, it's exhausting to even talk about, yeah. So I think we'll leave it at that. But I think on the whole, at the margins are where prices are still set. I think the smart money, and I almost hesitate to use that term, but I think the smart money is where prices are set.
I think you're right about that, and we're getting a little bit long here today, so I will tell you that The markets have been red hot. There's just no way around it. I guess the oft-given reason why the markets have been hot for the last 7 months, really in particular, and a good chunk of last year, but not all of it, but the last seven months in particular, understanding we're in the 5th month of 2024, is due to the fact that people were anticipating cheaper money at some point in the not so distant future that would cause earnings to accelerate more rapidly. However, we haven't had that cheaper money, and earnings still continue to be strong, so people didn't see any real reason to sell what they purchased in anticipation of cheaper money. And now we're sitting here waiting. Maybe we get rate cuts this year, maybe we don't. But as long as corporate America continues to put up decent, it doesn't have to be awful, but as long as they put up decent earnings results, you're going to be very hard pressed to have a lot of people sit there and say, I'm going to sell these stocks, realize a pretty sizable tax bill when things are moving along okay.
Yeah, it's you need a bigger reason to do it, especially we said up 12% almost on the year, and people are talking about 5% yields being awesome. You got that in like 4 weeks.
Yeah.
You need a better reason than 5%, I think.
And I think you're probably right. And so I think we're in it all. Push comes to shove. Absent some sort of massive flock of black swans, we're not going to see that market collapse that most people were concerned about. I would be surprised if the markets continue to increase the way that they have, just if nothing else out of sheer exhaustion. However, it's going to require something. Earnings misses, dirty bomb going off in the U.S., something along those lines, in order to, I think, shake the U.S. investors out of their positive nature right now.
Yeah, I think that's human intuition.
Yeah, I think that's human intuition, and if the news isn't bad, there's no reason to pay the tax man, all that bad stuff. So that's kind of where we are. It's kind of a vague answer, but until something a little bit more negative happens in the economy or geopolitical events, and it can't get much more negative in a lot of ways, until something really detrimentally impacts the United States directly, either on the economic front or military or what have you, I just see U.S. investors continuing to be relatively sanguine about the future.
I agree.
All right. Guys, we always love to hear from you. Also, if you have any comments or questions, please, by all means, let us know. You can always drop us a line at tradingperspectives@oakworth.com, or you can leave us a review on the podcast outlet of your choice. As interested, if you would like to hear or see and read even more than that, you can go to our website, oakworth.com, OAKWORTH.com. Take a look underneath the Thought Leadership tab and find links to all kinds of exciting information, including previous episodes of Trading Perspectives, our blog/newsletter Common Sense, and then our quarterly analysis magazine, Macro and Market, on top of all other kinds of exciting stuff. With that, I'm going to give Sam one last time to say something just like cripplingly intelligent about this topic.
I'm letting you down. That's all I got.
Well, I'm going to let myself down here today, too. Y'all take care.